Hello everyone, this is Brian and today we are going to review Audit Planning Memo on how to perform procedures. Procedure is the last section of Audit Planning Memo and it deals with risk assessment and mitigation strategies. Auditors must carefully plan audit planning starting with risk leading to procedures. Assertions. Risk of material misstatement is what drives audit effort. Managers make assertions about each other included in the income statement and balance sheet. Auditors use these assertions to evaluate risk of material misstatement and to design audit procedures. There are two occasions when an auditor refers to assertions for. Account balance and disclosure refers to balance sheet. On the other hand, transactions and disclosures refer to income statements. Assertions in balance sheet. There are relevant assertions for account balances and disclosures. There are a total of 6 assertions. Existence. Do the assets and liabilities and equity of the entity exist? For example, entities can send confirmations to customers to confirm amount owed. Rights and obligations. Does the entity have legal claim or control the rights to the asset? For example, auditors can inspect loan agreement to ensure client is in compliance with this debt. Completeness. Have all the entity's assets, liabilities, and equity been recorded? For example, auditors can reperform a floor-to-sheet test count of inventory. Continued with assertions in balance sheet. Accuracy, valuation, and allocation. Have the assets, liabilities, and equity of the entity being included in the financial statements at the appropriate amounts. For example, examining receipts for the accounts receivable balances older than 90 days. Classification. Have the assets, liabilities, and equity of the entity being recorded in the proper accounts. For example, reviewing accounts receivable for customers with if some should be classified as liabilities. Presentation. Have the assets, liabilities, and equity been appropriately aggregated and have disclosures been made that are relevant? For example, sending confirmation legal letters where disclosure is required. Let's now go over assertions in income statement. Occurrence. Have the revenues and expenses occurred? For example, reperforming payroll journal entries by vouching payroll expenses per the general ledger. Completeness. Have all the entity's revenues and expenses been recorded? For example, inspecting sales invoices to the general ledger to ensure the sales were recorded. Accuracy. Have the entity's revenues and expenses been recorded accurately? For example, recalculating interest expense using determined rates. Continued with assertions in income statement. Cutoff. Have the entity's revenues and expenses been recorded in the correct reporting period? For example, inspecting shipping documents to verify the date. Classification. Have the entity's revenues and expenses been classified to the appropriate accounts? For example, reviewing general ledger and invoices for appropriate classification of expense accounts. Presentation. Have the entity's revenues and expenses been appropriately aggregated and disclosures have been made are relevant? For example, inspecting details to determine if revenue is disaggregated to various revenue streams. We can look at two scenarios to understand assertions in balance sheet and income statement. Suppose that you have a piggy bank where you save your money. Every month, you count how much money you have put in your piggy bank and write it down on a paper. This paper is like your balance sheet because it shows what you own at a certain time. Completeness makes that your paper has all the money that you have in your piggy bank and does not miss anything. For example, if you have $10 in your piggy bank, but you only write $8 on your paper, then your paper is not complete because it misses $2. This could happen if you forgot to count some of the coins or if someone takes some of your money without telling you. This is bad because your paper does not show the true amount of money that you have. The balance sheet is incomplete. On the other hand, if you have $10 in your piggy bank and you write $10 on your paper, then your paper is complete because it has all the money that you have in your piggy bank and it does not miss anything. This is good because your paper shows the true amount of money that you have. The balance sheet is complete. For example, suppose that you have a lemonade stand where you sell lemonade to customers. Every day, you count how much money you make from selling lemonade and write it down on a paper. This paper is like your income statement because it shows how much money you have in a certain time. Occurrence means that your paper has the money that you actually make from selling lemonade and not fake or wrong money. If you sell 10 cups of lemonade for $1 each, but you write $20 on your paper, then your paper is not true because it has fake or wrong money. This could happen if you lie about how much you sell or if someone gives you fake money. This is bad because your paper does not show the true amount of money that you make. On the other hand, if you sell 10 cups of lemonade for $1 each and you write $10 on your paper, then your paper is true because it has real money. This is good because your paper shows the true amount of money that you make. Planning procedures. It is auditor's responsibility to design audit procedure considering nature, timing, and extent. There are two types of procedures. Test the controls, evaluate the operating effectiveness of controls. Substantive procedures, audit undertakes possible misstatement at the assertion level. Next slide, we are going to delve into test the controls and substantive procedures. Test of controls. Test of control is only used when control risk is low and a combined approach is used. Audit evidence from understanding the business to reduce the risk of misstatement. Auditor looks at procedures performed by the client during financial year rather than year-end figures. Substantive procedures. Substantive procedures is testing the figure appear in the financial statements. It is done at the assertion level. There are two categories for substantive procedures. First is test the details, which is selecting items within the population for testing. Substantive analytical procedures is evaluating financial information, analyzing both financial and non-financial data. Let's look at an example. Keyboard Guys Inc. manufactures computer keyboards and sells keyboards to retail stores and online. The entity is a manufacturing company that produces and sells various products to customers. The entity has a large amount of accounts receivable from its sales and also maintains an allowance for doubtful accounts to account for the possibility of uncollectible debts. We must assess this example using RAP, risk, assessment, and procedure. First, risk, understatement and omission of revenue, and overstatement and misclassification of expenses. It is possible to understate the revenue due to large amount of accounts receivable. For assessment, revenue, we are concerned about completeness and occurrence, cutoff and presentation and disclosure. For bad debt expenses, existence and occurrence, cutoff and presentation and disclosure. Lastly, procedures. Select a sample of sales invoices issued before and after year-end. Inspect the date of shipment and the date of invoice to determine if revenue is recorded in the correct period. By inspecting the sales invoices and the shipping documents, the auditor is gathering evidence over the occurrence and cutoff of revenue transactions. Let's look at another example. Retail Girls Inc. is a retail store that sells various products to customers. The entity has multiple bank accounts for different purposes, such as operating, payroll, and savings. The entity also has various liabilities, such as accounts payable, loans, and taxes. We again must assess this example using RAP, risk, assessment, and procedure. First, risk, overstatement and misappropriation of cash, and understatement and misstatement of liabilities. Multiple bank accounts can be easily led to misappropriation of cash and misstatement of liabilities. For assessment, cash, existence and rights and obligations, valuation and allocation, and presentation and disclosure. For liabilities, completeness and rights and obligations, valuation and allocation, and presentation and disclosure. Lastly, procedures. Perform a bank reconciliation for all bank accounts at year-end. Compare all bank balance per bank statement with the bank balance per the general ledger and identify any reconciling items. By performing a bank reconciliation, the auditor is gathering evidence over the existence and valuation of cash balances. The auditor also checks if the liabilities are properly recorded and disclosed in the financial statements. In summary, assertions are a company's official statement that the figures the company is reporting are accurate. Assertions are made to attest information on balance sheets and income statements. Tester control verifies the reliability of testing systems that detect errors or discrepancies in financial records. Substantive procedures identify errors or discrepancies in financial statements or accounting procedures. That's it for the lesson on procedure from Audit Planning Memo. I hope you find the lesson helpful for understanding, and feel free to contact me if you have any questions. Procedures is the most heavily tested topics in CPA exams, so it's very important to know how to perform RAP. Stay positive and have a great day.